The Nasdaq and S&P 500 both fell slightly Thursday, but the day's downward turn came after a record-breaking year so far. Two of the major stock indices, the S&P 500 and the Dow Jones Industrial Average, are both up more than 15% compared to a year ago. Financial analysts point to this as an example of the U.S. economy's health. But the benefits are not accessible to all Americans. Only 21% of Americans own individual stocks, and a smaller number invest directly in mutual funds, according to the Federal Reserve. Even 401ks and IRAs, the retirement accounts companies encourage and sometimes contribute to, are not owned by all Americans. Only 54% of all Americans have any kind of stock-based retirement fund. For those who are invested in the stock market, as of this January, the richest 10% of U.S. households owned $42.7 trillion in stock market wealth, or 93% of the entire stock market's value. A rally on Wall Street doesn't necessarily translate to more money in your pocket on Wall Street. While the median pay package for CEOs, many of which are tied to stock market performance, rose 12.6% in 2023, according to an AP analysis, wages and benefits for their employees only rose 4.1%. And they're feeling that pinch at the grocery store. Prices are 23% higher than they were 5 years ago, despite the inflation rate dropping back to around pre-pandemic levels. The effects are the most visible in the staple goods lower-income families rely on: bread, milk, eggs. And there's this phenomenon called cheapflation. So let's say you're looking at different brands of pasta sauce. The cheapest bottle actually had its price rise the most due to inflationary pressures, while the most expensive one has had its price impacted the least. So with 63% of Americans recently polled by CBS News viewing the economy as bad, this disparity could explain why, despite the stock market reaching record highs and GDP continuing to grow.